Welcome to another business finance short problem solving lecture. We will now have a look at study problem 12-2 in page 412 from the 8th edition of our textbook. Here's a view of the problem. Let's go ahead and highlight some key facts provided in the problem. We are provided with the income statement for Hugo Boss Corporation for the most recent year's operations. Sales through net income are listed in a fashion where we split the expense items by variable versus fixed cost, and then we are also given the interest expense and taxes as well. So we have two objectives in this problem. The first objective being that we need to figure out the break-even point sales dollars for the company, and second of all, we want to have a scenario analysis and figure out what would be the increase in earnings before taxes should sales increase by 30%. Regarding part A, it's quite clear to apply the formula directly, and I will go ahead and do that now. So the break-even point in sales dollars is equal to the fixed cost divided by 1 minus variable cost over sales. Now fixed costs, recall from the table, was equal to $10,143,000, whereas variable costs equal $25,137,000, and finally sales total $50,439,375. So making the calculation, we realize the break-even point in sales dollars equal $20,205,179.28. So that would answer part A of our problem. Now going back in part B, recall the hypothetical case. We are curious in the increase in earnings before taxes, the item on this line, should sales increase by 30%. So I will introduce two different methods to solving this problem. The first method is without using any degree of operating leverage, making direct calculations. So sales increasing by 30% would bring sales all the way to $65,571,187.50. So that's associated with a 30% increase in sales. Well, variable costs will increase proportional to what it was previously. Obviously, the ratio between sales and variable cost is 0.49. You can simply calculate it by dividing this figure, variable cost figure, by total sales. So that fraction, that ratio will be preserved, meaning we multiply our number 65 million with this 0.4984, and we get that variable cost would be $32,678,100. So looking at the difference here, we get the figure $32,893,087.50. And guess what? The increase in revenue before fixed costs is still 30%. So a 30% increase in sales results in a 30% increase in the revenue before fixed costs. Now, fixed costs would not change as a result of an increase in sales, so therefore the same figure will apply here. We look at the difference and we realize it's equal to $22,750,087.50. Now this number is actually a 50% increase from its previous level, So the increase from 15 million to all the way to 22 million is a 50% increase. And finally, the interest expense is also fixed. So $1,488,375 deducted from this previous figure of earnings before interest and tax. We get the number $21,261,712.50. Now the interesting question would be, what is this increase? So what is the increase from this to our new figure here? And it comes as 55.50%. To get this number, all you need to do is to divide this number, this 21 million, by this 13 million figure, and you will get to this number. Now, as you can see, this is quite a tedious work. Lots of calculations here, and basically reproducing the income statement based on this hypothetical 30% increase in sales. Well, there's a faster, much more efficient way to calculate the percentage increase in earnings before taxes as a result of an increase in sales, and that would be by using the degree of operating leverage. In the next step, I would like to use that as a second alternative solution actually, and see if we can get that same 55.50% figure. Okay, so for that, in part B, the degree of operating leverage is simply equal to revenue before fixed costs, all divided by earnings before taxes. Well, the revenue before fixed costs is equal to this number divided by earnings before taxes in the following amount equals 1.85. Now this is our degree of operating leverage. Now we can calculate the percentage, so percentage increase in earnings before taxes and net income, the two would be equal actually, is equal to percentage change in sales, obviously, in sales, times that degree of operating leverage. Now, the percentage change in sales hypothetically is 30%, a 30% increase, that's why I added that plus sign, multiplied by the degree of operating leverage in the amount, as a factor, so which is 1.85. Multiplying these two numbers, we come across the same figure, the same increase in earnings before taxes. This is a much more efficient way to calculate a percentage increase in earnings before taxes as a result of an increase in a percentage increase in sales. So that would conclude our solution, and hope to see you in the next video.